My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin. LME 3-month nickel. The most significant feature of this market in recent weeks has been the very significant lows of 2021 at 15,665, which led to the lows of late November 2023, plus this year January, February, and some mild finessing the lows of late July and early September in the 15,840 and 15,600 area zone. This support zone created the lows of late July at 15,600 and early September at 15,665. It is at this point that I feel obliged once again to mention the big descending scallop pattern I've been going on about for months now, and what it may mean within the near-term universe. So the key level has been and is the lows at 15,840. A significant move below these, and by that I mean that you would know it when you see it, a significant break below that level would give a potential downside for the descending scallop pattern in the 13,830 zone, which would not be too far away from the potential below for the old bearish half hesitation seen over June and July that eventually never materialized. It still all came down to what the market has done and even now still might do with the 15,840 zone. First time around in late July, prices chose to bounce back upwards, and during the start of August sustained the bounce, moving higher, slowly higher overall. However, over mid-August, prices had an issue with testing the June 2021 low at 17,095. And I suspect indirectly the overhead very slowly declining gold long moving average, currently at 17,335. This suspicion eventually evolved into a mid-July, early September ascending wedge pattern. Early 5 weeks ago, prices broke down through the now ascending wedge pattern, easily reaching the primary target and close enough to the secondary target down at the July low at 15,600, enough that I chose not to designate it. However, we then saw prices build upwards again, enough for me to draw a bright red late July, mid-September bullish Andrews pitchfork. I said on this 3 weeks ago, and I quote, "It is a nascent one, and I am quite prepared to retire it if it doesn't fit, especially if the support down at 15,600 being so close gives way," end of quote. I continued, and I quote, "The one other thing I would like to mention is that we might just form a possible double bottom over the action from July to date. It is way early to really consider this, but keep it in the back of your mind in case the 15,600 July low holds prices up and we really start to see the beginnings of a pullback up," end of quote. Well, since then the bright red bullish pitchfork has held, and we have seen last week prices moving up and breaching, if temporarily, the upper time currently at 18,065, as well as stabilizing over both the gold long moving average and the mauve declining medium moving average currently at 17,170, as well as testing the October 2019 high at 17,815. I added last week, and I quote, "Not only all of this, but the price rise triggered the opportunity for the July to date double bottom. Thus we have a primary target X in the 18,140 area and a secondary hard to reach target X1 in the 18,665 area. In the way, bar the bright red upper time and October 2019 high, is the July 2022 high at 18,265. But the more interesting features around the target X1, where we have not only the June high at 18,610, but the interesting 50% Fibonacci line of the big mid-May to late July move at 18,680. Indeed, you could call this area a small congestion band, 18,610 to 18,680, end of quote. Since then, we have seen prices achieve the primary target X in the 18,140 area, but so far failed at achieving the secondary, harder to reach target, having been stopped by the July 2023 low at 18,265. The stopping has been enough for me to consider that perhaps, just perhaps, we have a small possible horn top pattern forming over the last week and this week. We nevertheless are still within the bright red bullish Andrews pitchfork and above the gold long and medium moving averages. And until these are taken out, I will maintain target X1 up in the 18,665 area. LME 3-month zinc. This is a very busy and colourful chart, but I apologise, but all these patterns do relate to what is going on right now, so let me explain. 6 weeks ago, prices drove higher, prompted by a small, late July to mid-August reverse head and shoulders pattern over, there's a long list here, the June 2021 low at 28.10, over the broken old dark blue upper time, currently at 28.41, the May to August 2023 bullish shift pitchfork that subsequently acted as an August 23 to April 24 upper bull channel line, then the short medium moving average, currently 28.44, the medium moving average, currently 28.77, a congestion band between 29.58 to 29.65, containing the April 2019 high at 29.59, and a 50% Fibonacci line of the big old 2008-2022 move at 29.65. Further up, the green middle time, currently at 30.21, of the February to August bullish shift pitchfork. Then just over the 3,000 level, the July high at 30.2022, followed by the purple neckline extension of the September to December 2022 reverse head and shoulders pattern, currently 31.39. And finally to slow over this purple neckline and halt just shy of the June 2018 high last week at 32.20. As is obvious, all this countered quite strongly July's monthly key reversal down. As a consequence of this move up, I laid out 4 weeks ago some potentials topside for the original reverse head and shoulders pattern, with a primary target in the 3009 area and a secondary harder to reach target in the 3087 area. Back in late August there was enough to turn prices lower, especially I suspect the green middle time at the time, all the way down to just below the long moving average, and the congestion generated during late July and August. However, once there, the congestion held, somewhat surprisingly I think, and the move up saw the targets, the ones I've just mentioned, finally reached 2 weeks ago. I said last week about the top side that, and I quote, prices have moved higher still to now test what I suppose is the holy grail of the market, the purple neckline of the September-December 2022 reverse head and shoulders pattern. This could become a seminal moment, so watch carefully as prices have also formed another pattern, an early August to date bullish halfway hesitation, that achieved its topside in the 30-60 area in the middle of last week, so that's 2 weeks ago. Plus another pattern that is still operational, end of quote. On this still operational pattern, I said 3 weeks ago, and I quote, I've also drawn a new early August to early September bullish Andrews pitchfork highlighted in bright red, and a renewed hope in showing the bullish angle of attack of this market, end of quote. Well, this bright red bullish pitchfork is even today still operational, and despite today's pullback it's still doing a good job of showing the bullish angle of attack. We are in between the overhead bright red middle time, currently at 31.57, and the lower time below, currently at 29.60. I asked last week, and I quote, the question now is whether the market will falter here, much as it did in late May, or will it really go for the higher price, end of quote. Today it seems we have the beginnings of the answer. LME 3-month tin. Prices started their recent build higher down at the congestion between 28.835 to 29.005, containing the July 2011 high at 29.005, plus the important slowly rising long moving average, currently at 30.225, and the nearby neckline extension of the October 23 to January 24 reverse head and shoulders bottom, currently at 28.235, and finally the 50% Fibonacci line of the March 2023 to April 2024 move at 27.330. All these slowed, stopped, and at the start of August turned prices higher. The pushback up then became stuck in what I can best describe as an accidental congestion area overhead created by a combination of the medium moving average, currently at 32.140, short medium moving average, currently 31.615, the 50% Fibonacci line of the March 2020 to March 22 move at 31.845, plus the neckline of the thin and tall April-based head and shoulders pattern. Yes, that one. The one I mentioned a lot back then, and that's currently at 31.875. Prices were stuck there until 3 weeks ago when they broke higher, moving up over an earlier all-time high from April 2011 at 33.610, and up to the 50% Fibonacci line of the March to October 22 move at 34.175, where they breached but could not break any higher. I said of this 50% Fibonacci line, and I quote, This latter one seems to me to be a significant level, but we'll see. To help clarify this move higher, I drew 2 weeks ago. So that's now 3 weeks ago. I drew 2 weeks ago a late July to early September bullish Andrews pitch wall highlighted in dark blue on my daily chart. End of quote. This is not a perfect pitchfork, having been penetrated 2 weeks ago. However, the market still utilized it until today, when the price is pushed down through the dark blue lower time, currently at 33.065. At the moment, this is still just another breach, but in anticipation of a possible break lower, I've already started to finesse the bullish Andrews pitch wall into a shallower bullish shift pitch wall, unhighlighted for the moment, but that's for the same move. On this pattern, which does look good, today prices have punched down through the middle time, currently at 33.025. The lower time below, currently at 31.070. There is significance in this punching through. I just wish to point out that volatility is a common feature, such as we have seen today at the crossover of related times. So this volatility is not out of place. I'd just like to point out that below, we now have a dynamic congestion band today between 31.615 to 32.140, made up of the medium moving average, the old thin head and shoulders top neckline extension I previously mentioned, currently at 31.875, the 50% Fibonacci on the March 2020 to March 22 move at 31.845, and the short medium moving average. This seems an obvious support zone below. Now, one final point I'd like to mention, and it is an old one which I will retire after this commentary. We have a target X above in the 34,500 area. This is the target for a possible late July to date bullish halfway hesitation. I called it a possible pattern last week, but it no longer looks like it may be possible, having come awfully close last week. So I will retire it after this commentary. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.